On February 20, 2026, the U.S. Supreme Court ruled 6-3 that the broad tariffs imposed by Trump under the International Emergency Economic Powers Act exceeded presidential authority and were unlawful. The decision is not only a judicial rebuke of unilateral trade policy, but also marks the beginning of a deeper three-branch struggle over trade power. Global trade has now entered a new phase defined by precision-based gamesmanship and persistent uncertainty. The U.S. Constitution explicitly vests the power to levy taxes in Congress. The relevant statutes only authorize the president to regulate property or restrict transactions. They never explicitly grant the power to impose tariffs. Citing the major questions doctrine, the court stressed that any sweeping tariff policy requires clear congressional authorization. The president cannot unilaterally expand his authority. The ruling affects an estimated $175 billion to $180 billion in already collected tariffs. Importers have flooded courts with refund lawsuits, putting the federal government in a bind. Paying refunds would widen the deficit, but refusing would violate the law. Within hours of the ruling, Trump launched a legal counterstrike. Citing Section 122 of the Trade Act of 1974, he announced a 15% temporary tariff on all U.S.-bound goods from around the world, set to last 150 days. Any extension would require congressional approval. He also kept intact the targeted tariffs under Section 232 and Section 301. The maneuver shifts trade policy away from reliance on broad emergency powers toward more targeted, procedurally complex legal tools. Market uncertainty hasn't disappeared. It has merely changed shape. The global trading system is absorbing multidimensional shocks, with supply chains experiencing both short-term repair and long-term distortion. The rollback of the original tariffs lowers trade costs for sectors such as autos, electronics, and machinery, nudging resource allocation back toward efficiency. Yet the new levy, layered on top of existing targeted duties, continues to disrupt supply chains. Companies are forced to raise contingency buffers, dragging on trade efficiency over the long run. By consistently placing U.S. domestic law above WTO rules, Washington has steadily eroded the authority of the multilateral trading system. Global trade is shifting from a rules-based multilateral framework toward bilateral and ad hoc arrangements driven by political calculus. Countries now prefer to negotiate directly with the U.S., weakening the impulse for collective retaliation. The impact of the new tariffs varies across economies. EU members, the UK, and Japan see some relief in actual duties paid, but manufacturing-heavy nations like Germany and Italy face significant pressure, making it difficult for the EU to forge a unified, tough stance. The US economy is grappling with multiple double-edged effects, leaving inflation and monetary policy in a bind. The cancellation of the original tariffs theoretically eases imported inflation, but the new 15% levy pushes prices up again. Morgan Stanley now projects 2026 U.S. inflation will be higher than previously expected. Greater inflation stickiness would further constrain the Fed's room to cut rates, potentially forcing a longer period of tight policy that weighs on growth. Profit margins in import-dependent sectors such as retail, tech hardware, and autos are squeezed directly. The policy whiplash severely undermines business confidence. Moody's chief economist notes that such uncertainty will lead firms to scale back expansion, investment, and hiring, a purely negative outcome for the U.S. economy. Tariffs, as a hidden tax, ultimately fall on consumers, costing the average household an estimated $1,600 per year. Meanwhile, demands for tens of billions in tariff refunds pile fresh pressure on the already strained federal budget, ensuring that uncertainty persists as a market factor. Market sentiment pivoted swiftly after the ruling and the new tariff announcement. Risk assets rallied briefly after the decision, while safe havens strengthened intermittently after the levy was unveiled, reflecting lingering concern over long-term uncertainty. Looking ahead, 3 scenarios are possible. The base case, with the highest probability, congressional deadlock prevents an extension of the new tariff after 150 days. The administration pivots to industry-specific investigations. Global trade enters a phase of normalized friction with manageable escalation risk. In a positive scenario, Congress rejects the extension, and the judiciary further curbs presidential trade authority, significantly reducing trade uncertainty. In a negative scenario, Congress approves the extension and launches new probes, prompting retaliation and raising stagflation risks. This tariff episode is a vivid demonstration of U.S. checks and balances in action, and a snapshot of globalization at a crossroads. It shows that unilateral protectionism faces not only external international pressure, but also hard constraints from the domestic legal system. For global businesses and investors, the binary mindset of trade war escalation or resolution is obsolete. What lies ahead is an era of precision-based gamesmanship. Industry impacts will be highly divergent, policy tools will become more varied and legalized, and uncertainty will be the norm, not the exception. Global prosperity cannot be built on tariff barriers. It ultimately depends on open cooperation, shared rules, and mutual benefit. The Supreme Court's ruling did not end trade friction, but it provides an important opportunity to bring trade policy back into a legal framework and to reaffirm multilateral rules in global governance. Understanding the legal logic, economic forces, and political calculations behind this contest is the key for market participants to navigate challenges and seize opportunities ahead.